Diversify's call. This is our last Tuesday, I guess it is in August, right? I'm losing months here, but we're so excited that you could join us for this call. We have a special guest coming up later on that we'll be revealing to you. But tonight's call, we're going to be talking about we're going to be talking about protection, insurance, different things that we need to be cognizant about when we're thinking about our future, our finances, even protecting our family for today. So there's so many different things that we need to dig into tonight.
Most definitely. And that topic is actually about insurances. It's a topic that for the most recent years, right, the government really took a very active role on actually requesting, at least on United States, requiring everyone to have health plan at minimum. And we all were able to see how our payroll was deduced, right? Because we started paying a lot more money, like a higher amount of money than what we were being deducted before for health plan. Even within the last couple of years, health plan continues to go up. However, we also want to talk about other types of insurances, right? And why is it important? And I believe, for example, I just want to share something about what happened to us, Shan. How about
exactly. But before we do that, we do want to say that we have Stephanie Leffer with us tonight. She's going to be pretty much moderating everything. So if you have anything that you want to questions, you could put in the chat. She's going to be watching those things. As we're growing Diversify, we're trying to bring more people online, more people to share their story, share what kind of business they do. So this is just the next iteration of what we're doing. So feel free as we're talking, put in the chat your questions and everything, and then Stephanie will pass them off to us.
Most definitely. Thank you.
Now you can go back to your story.
So a couple of years ago, our son, my stepson, was in a car accident. And in that car accident, obviously, we were all like amazed. We're trying to make sure that he has the best hospital that he's been attended. So fast forward, it was a car accident. He was doing well, but he was taken in an ambulance to emergency. So a couple of months later, maybe even a year after, we got a bill. And surprising when we looked at that invoice for the amount that we were being charged for the ambulance, for the emergency, and we were like, we don't have that kind of money. But you know what was a blessing that we had, an opportunity that we had a health plan, and we also had a vehicle insurance. And because we had those two types of insurances, then those two types of insurances together were able to pay for all of the medical bills for his emergency. At that time, we understood the importance of insurances. If it wasn't because we had those policies that we have been paying every single month, just a little bit amount or maybe a large amount, right? For some of us, we had been in a very big debt, and a very like, how would you call that? Like not easy situation, right?
We could have been in a pit.
Because it might have been like $20,000 between ambulance and emergency and all the different x-rays that they did and the doctors. So that's one of the reasons a couple of weeks we were talking about, hey, what are we wanted to share? And we just want to make sure that as we are moving forward and you're building wealth, you're developing the different strategies, you also keep in mind the importance of having insurance policies, having that covering when you are making money, but also any emergency, a situation. I mean, Chad the other day was like cutting something and cut himself with a knife. And, we're like right there. And guess what? We're thinking, okay, is this a situation of taking Chad to an emergency? Right? We do that. And then after the fact, what happens? In our case, we didn't have to take him to emergency. However, it is important because in those situations, right, that's when you're like saying, oh, wow, I wish if I would have had insurance, or I wish I would have done this different type of insurance to make sure that now I'm not using my savings or just having to pay medical bills for the next 20 years.
Yeah, so there's all kinds of different insurance. You know how we've talked about over the past couple years about building wealth, about budgeting, about planning. So the purpose for all these different insurances, which I don't like to pay for any of them. And none of us want to have insurance. I don't like paying car insurance. I don't like paying homeowners insurance. I don't like paying life insurance, health
Renters
insurance,
insurance.
renters insurance. But the reality is those insurances are an investment into protecting all your assets, protecting the things that you do have, because you work hard. You work hard to save money.
Yes.
You work hard to build. You work hard to invest in things, build businesses. And for one tragedy, one major accident to come and wipe all of your years of hard work, it's not fair. It's not right. So the best way to protect that against is different types of insurance. And then this evening, we're going to talk about planning for the future, and insurances like we need to think about going even when we get older, or, future planning.
Most definitely. And all of us know people that are over 70 years old. And in my example, like we've seen their struggle. They're getting older, they're retiring, and whatever they had invested wasn't enough. You see them, you see our parents, or you hear them calling Medicare and supplemental and getting all of these different types of insurances because everything is increasing in cost, and what they thought that they had to be able to support them through their elderly life is not anymore like enough. It's not enough to cover their needs. So it's even about, like you were saying, Chad, talking about the future. Even if that future is 40 years from now, 30 years from now, the future of our children, our own future, the future of our parents, how to even help them have those different types of conversations. When one of them calls you and it's like, hey, I fell, and we start thinking, well, we don't have enough money to have someone to take care of them. They don't have enough money. And all of those conversations come into our home, and we don't have the mechanisms. We've never heard about it before. This is a topic that it's not spoken, right? We never hear about, hey, our parents are really struggling with their life. What do we do? How do we plan for it? And as I'm even sharing about this, I'm thinking about my grandmother, when she was in her elder years. I'm thinking about our parents. So it's so important to have knowledge and wisdom on how to be able to have those conversations, especially as we move forward.
Yeah, we want to be able to equip you guys to plan for the future, to be able to just set a clear path. So no matter what you do, you're going to be successful. Like I said before, this is not fun. It's something not talked about. Nobody wants somebody coming knocking on their door trying to sell them insurance. And that's just one things we don't, but it's one of the most important things that we have to revisit. Even your car insurance.
Yes.
So this goes for like budgeting. So for car insurance, if you haven't checked your car insurance against another company in the last year or two, you're probably overpaying. We just recently,
Yes.
our two vehicles, we switched. We had one carrier, and then we've had them for years. They have our rental properties, they have our homeowners, our cars. Well, we started shopping around because every year they go up and up. And we literally were able to save 50%. I mean, it's hundreds and hundreds of dollars a year just by shopping another carrier. So that's one way that you could pretty much cut your insurance costs down like today. If you haven't done, I could promise you, if you have not looked at your insurance in the last couple years, there's another company out there for vehicle insurance that is going to be less money.
And also for the houses,
And homeowners
right?
also too.
So even if you are paying a mortgage, and within that mortgage you also pay your house insurance, you can also go out there and shop for a new house insurance. So there's opportunities where you can even have an umbrella, or you can go to a broker and ask them for a car insurance and also for a house insurance. But in the example that we're sharing, we actually had to take the vehicles out because we were thinking we were saving, and we were not saving money. But with that, we're also going to transition into having more conversations about the houses, because guess what? Yes, there's a battle. People like agencies are increasing their cost for our house insurances, but you have the opportunity to search for the different ones. You do not have to stay with the same company for years and years to come. And it's important, as you have these conversations, take notes, ask them to send you the information via email so you can compare and make sure that you're comparing apples to apples, right? If it's like a car insurance for both, like 100%, you want to make sure that you continue carrying that type of insurance to your next company.
The same coverage. And also
Yes.
another type of insurance that people forget about is if you have a mortgage, you say you bought your first home, your second home, and you have an FHA loan. So if you didn't put the 25% down when you first purchased your property, there's a thing on there that's you get a certain insurance that's put on your loan called property and mortgage insurance, PMI. Usually see that little line on your mortgage. Once that's if you've owned your house for a while and you've been making that payment, say you've owned it for like 15 years, there's opportunities that you could go to your bank, go back to them and have them look at the value of your house to have that PMI removed because you've paid it down past the 25% down payment. And then they're required to remove that insurance. So that could save you hundreds of dollars a month also if you haven't looked at that.
And even I had an apartment here in Puerto Rico many, many years ago. And guess what? I was able to pay for an appraisal, and they removed my PMI because my property value went up. And, when I was doing my numbers, I was like, well, I'm going to save more money by getting the appraisal right now and not having to pay this PMI every single month. And my monthly payment went down significantly. So that's another great example of insurance.
Yeah. So there's, insurance can be fun. I mean, you can save money with insurance if you start digging into it. I know it's a lot of work sometimes, getting all your documentation together and, making the phone calls and searching everything, but it's not, it's to your best interest to do that and spend some time going through these things. At this time, what we want to do is have Stephanie introduce our guest that's going to talk about like future planning and different types of insurance that we really haven't discussed yet.
Hey, I'm super excited to invite Florian to the floor to share tonight. He's our insurance expert. Welcome, Florian.
Thank you, everybody. And I apologize for the lighting. We have no power. Our block and two other houses have no power. So a transformer blew up like about 20 minutes ago. So that's why we have this awkward lighting here. But no, I'm glad to be here. And with your permission, I'm just going to jump right in.
Sure. Thank you, Florian.
Yes. So a couple of things. I've been involved in mortgages. I was a loan officer for about 15 years. The last 7 years, I've been focusing on insurance and retirement planning. A little different from what the dealers are taking, but still, definitely retirement planning. So let me ask you a question. What's the first thing you think about when you hear the word insurance, right? So for some people, it's car insurance or home insurance, health insurance, or life insurance. I do not offer property and casualty. They call it P&C, property and casualty insurance, which means your home and your vehicle. That's another market. That's another platform. It's a whole nother business model as well. I don't do that. I actually have someone in Valparaiso that I go to that I trust, and every 2 years I do compare. But I've yet to see anything really for me. Just it's also a level of service that I get from my agent. I've had some issues in the past, so I would just say be careful of the premiums. Okay, if it's too good, there might be a reason, because their customer service might be really, really bad.
Yeah.
When you have a claim. Okay, so I would just say, hey, make sure, somebody mentioned apples to apples. It's a big difference. Is the replacement cost the same? Okay, are they what value are they putting on your home or on your vehicle? What's the deductible? What's the max out of pocket? So really, if you have questions, I could help you on the PNC side a little bit, but make sure it's apples to apples. Okay, so just a little caution there. But listen, when most people talk about insurance, for me, it's life insurance. I do write health insurance as well for people typically over 60, definitely people in the Medicare years. I do work with a local expert in Miller here. That if you're under 60, if you're not Medicare age, or you're in the marketplace or the ACA or the Affordable Care Act insurance, I have someone that could help guide you with that stuff. But for tonight, though, I want to talk about life insurance, okay? Because what are we protecting? What's your most important thing? It's your life is what we're protecting.
Mm-hmm.
So we protect, we protect assets, we protect our health, we protect our futures, we protect our legacies. And this is what life insurance is about. So it's difficult to make life insurance exciting. I think it's exciting. That is how I make my living. But what is insurance? Insurance basically is a risk transfer. Okay. So you buy a house and you insure it for $500,000. You are placing $500,000 risk over with the insurance company. That's what you're doing. You have a $30,000 car. You have a car insurance policy. What are you doing? You're transferring the risk in case of an accident, in case of loss of life. If you hit someone or someone hits you, you have insurance. So it's risk transfer. We're transferring risk. Okay. Same thing with health insurance. I'll give you a great example. I'm on Medicare now. But a year ago, I wasn't on Medicare and I had to go to the emergency room. I went to the emergency room and I had this piece of garbage insurance. I won't mention who they are right now. If you want to find out, text me. But in Indiana, there's only 2 or 3 companies that you could get insurance through in the marketplace. And they're both terrible. They're very high deductible. The premiums are outrageous, but that's the only game in town, unless you have insurance through your employer or perhaps through your union, or maybe some kind of group. But it's expensive. But my trip to the emergency room came back and it was $3,400. And I was there for 2 hours. They gave me 2 pills. They took several tests and it was almost $4,000. Okay. My share of it was $1,000. All righty. So I think I got off kind of cheap, but it was still $1,000 out of I had to write a check for $1,000. Yeah. Go a year forward, I wound up in the emergency room again. And that same, it was a different issue, but they still had to run some tests. I paid $90. Okay. Because now I'm on Medicare. Just to give you an example how crazy the coverage can be. So a year ago it was $1,000. This emergency trip was $90. All emergency room visits are $90 on my PPO plan through Medicare. All right. So I know none of you are 65 yet, but when you get there, call me. Right. But here's the thing to plan for, though. A lot of financial planners do not plan insurance when they do people's retirement plans. Okay. For whatever reason, they don't offer it, so they don't talk about it. Another thing, insurance that we talk about is long-term care. Now that I'm pushing 66 in a couple of months, my wife and I are looking at a long-term care policy just in case either my wife or I or both of us need some long-term care, meaning someone comes to our house and cooks and cleans and bathes us and it helps us get out of bed and things like that. So I'm not going deep into that today. I really want to talk about life insurance because I see the people who are in the group, though. Okay. So, and let me know how I'm doing on time. So I got 20
you're
after
good.
20.
You're good.
All right. So look, you transfer risk from yourself to the insurance company. That's what insurance does. So two types of life insurance policies. Okay. There's term insurance. All righty. Which what you usually see on TV, get $1 million life insurance policy for $30 a month. Can you? Yeah, you can. And there's also permanent insurance. So I want to take them one at a time. So you know the difference. All righty. And if I talk too fast, just tell me to slow down. Remember, I'm from New York.
We will do
So
that.
we talk fast. But I will slow it down though. Premiums are based on your age and your health. Okay. So the younger you are, the healthier you are, the lower your premiums. The premiums are simply the cost of the insurance. Okay. I'll give you an example. For someone who is 30 years old, all right, I don't know if we have someone who's 30 on here or not, but if you want to buy a $1 million policy, that means you die, you're a beneficiary because you're going to name someone who gets the money. So there's the owner of the policy, the insured, and the beneficiary. Okay. You can have a different owner. So for example, I have a policy on my grandson. Okay. I'm the owner. My grandson is the insured, and my son, his father, is the beneficiary. Okay. So three parts to that. But for example, a 30-year-old who wants $1 million policy for 20 years, because I know everybody's thinking, what does it cost? So let's get that out of the way. Okay. And so I'll give you a freebie here. $1 million, 20-year term. So 20-year term means you have this coverage, $1 million coverage for 20 years. So today's August 27, 2024. On August 27, 2044, it expires worthless. But you do have $1 million of coverage for a 30-year-old male in relatively good health. Okay. It's less than $40 a month. It's like $460 a year. Okay. And depending on your health. So if you're in better shape, it goes down. If you're in your worst shape, it'll go up a little bit, but about $40 a month. If you're 50 years old, okay, 1 year, 1 million for 20 years, they'll cost you $150 a month. Okay. So you see the difference, what 20 years does, assuming in your same health. But as we know over the years, unless you're Chad, you put on a few pounds and, and maybe you're not in great shape as you used to be. But that's the difference. So you can see how cheap insurance is, how affordable it is when you're 30. Okay. But it's like the dealers say, it needs to be part of your budget. Okay. So why would I need $1 million? So if somebody asks me, right, why would I need $1 million? That's a lot of money, Florian. I only make $50,000 a year. Okay. Why would I need a mortgage? Okay. Stephanie's in this group, right, Stephanie? How many children do you have, Stephanie? 4 kids. Okay. Now, I'm not asking how much money Craig makes. All right. So please no one yell out how much you make. I don't want to know. Well, let's assume you make 50,000. Let's say you're a younger couple, even younger than Stephanie and Craig. But let's say you are a 30-year-old couple. And look at our church. How many people come into church with 2, 3, 4 kids under the age of like 8? But let's say you make $50,000 a year and your oldest is, let's just say 5. Okay. And there are families. I know they're popping into your heads as I'm speaking. Okay. And you make $50,000 a year. If you were to die tomorrow as the breadwinner, okay, your wife still has to raise them, right? It's not like she gives them away because you're gone or something like that. But if you make, and you have to raise them to they're 21, figure until they come out of college, let's call it 20 years. What's 50,000 times 20? Well, my math majors, it's $1 million.
Dollars.
Yeah. So when you say $1 million, people are like, I don't need $1 million. So I don't make that kind of money. Well, you don't make it in a year. Not even the Dieters make. Oh, maybe they do. But look, man, the Dieters make $1 million. But over 20 years, even if you have a mid-level job, you'll make $1 million. Okay. Your wife or your husband still have to, in case you're the big breadwinner. So I'm talking to the ladies. You're still going to have to raise your kids. You still have mortgage payments. Maybe you want to pay off the mortgage. Maybe you want to fund college. So $1 million is not a crazy number by any stretch of the imagination. When we had 4 kids, okay, our oldest is 43 now, and our youngest is 30. How old is Christian? 31 now. We had $2 million of life insurance policy on me and $1 million on Sadie. Mm-hmm. And a conversation I had with my younger sister was that should anything happen to both of us, where we both die simultaneously or within a short period of each other, that she would raise them. Well, she can't send them there just in a basket. She was named, a trust was named as beneficiary. So that's another thing we could talk about, trust and everything else one day. But now that my kids are, my little one's 31 and he's doing very well for himself. I'm sure he's making close to 6 figures now. I have 2 insurance policies on me, and I think they add up to probably beneficiaries, probably less than $500,000 right now, because we don't need it. I'm working. I have other assets. So I don't have that same kind of risk right now. Should I die tomorrow, my wife doesn't have to raise 4 kids, or anything like that. So things change in your life. Okay. Stephanie, go back to when you and Craig, just got married. You had no kids. Okay. No need for $2 million. So what changes your need for insurance? So think about it. One is getting married. Okay. You go from a single guy where you're like, well, I really don't need insurance. I don't have kids. I don't have a wife or a significant other. So maybe I don't need insurance. So we could talk about that. But once you get married, you have to take care of your spouse, man or woman. Either way, you have to provide for them. Having a child, having 2, 3, 4 children, that definitely makes a difference. You want to protect your mortgage. So a lot of the conversations I have, if I die, I want my wife to pay off the house, or I want my husband to pay off the house. So we do that. Things that happen in your lifetime as well. Maybe you start a business. I know somebody, they're my clients. They bought a restaurant bar. They took on a $500,000 mortgage. They called me up. We said, hey, Florian, we need a 10-year term policy for $500,000 until we pay this mortgage business loan off. Just in case one of us drops dead, we could pay off the business loan. So you could see the different life events that would trigger a reason to go look out for more insurance. Okay. So somebody posted a question about expiring worthless, okay, or no value. So if you have for example, this couple, they have a $500,000 bank loan that they took out to open up a restaurant, okay, a few months ago. They also took out a 10-year term policy for $500,000. It's actually on both of them. It's a joint policy. So either one, should both of them die, or one or both of them die, Let me back that up. I wrote it where either one of them dies, the other one gets paid out on it. Okay. But should one of them die for a period of 10 years, the beneficiary get $500,000. After 10 years, they have zero coverage. So when I say expire worthless, a 10-year term policy means the policy is in effect for 10 years. A 20-year term policy is in effect for 20 years. A 30 is in effect for 30 years. So what determines how long the duration of the policy depends how long you need it. I mean, if the Leffords had 4 kids under 10, I would recommend a 20-year policy. Now that their youngest is 14 or so, they definitely don't need a 20-year policy. Okay, because they, assumingly in about 10 years, they're all going to be out of the house. Okay, or they'll have their own lives. So you don't have to provide for them anymore. So that's what you get term policy. So people on a budget need it. Okay. People addressing a specific risk for a specific time, young families, a lot of families that I work with that are in their 20s and 30s, they can't afford a permanent policy, which I'm going to talk to next.
There's a second part to her question, Florian, and
yes.
She asked, what are the options to renew or reevaluate the policy at the end of that term?
Yeah, sure. So a lot of them have a what they call convertibility option, which means you could convert it to a policy that will take you out to year 100. Okay. There's a time period. There's a protocol that you have to follow. When I do an intake with somebody, I'll say, yeah, okay, Stephanie, well, your oldest is 10, your youngest is 4, probably a 20-year policy. But you might say, well, I want to extend it till, assuming Stephanie's 25, let's say, we'll do a 30-year policy that'll take her to age 55. So I'll ask these questions and I'll prevent options for them. But there's convertibility. You could also write another policy. Okay. So there are options available for you. Okay. Let's see. So now let me talk about permanent policy. You've seen, so just remember what you see on TV is term policy. When they talk about $20, $30 a month for $1 million, they're talking term policies. Okay. The other one you see is final expense money. Okay. Which is pay the funeral. Okay. You see the guy $9.99. This one guy's on TV quite a bit. Colonial Penn. Okay.
Yes.
Yeah.
Which Colonial Penn, which I think United Healthcare owns, $9 a month or something, or $9.99 a month. Yeah, no questions asked. But the policies are typically $10,000, $15,000, basically enough to bury someone. Okay, my mother just passed away a month ago. We took out a $25,000 policy years ago, and she passed away. My sister got a check for $25,000 and used 15 of it to pay off the funeral, in the lot. And there's $10,000 left over for my sister. My sister's 7 years old, and we're going to use that money to pay off her funeral. So there are funeral policies. They're called final expense policies. The premium is low, but you're not getting $1 million either. Okay. So it depends how old you are. And typically people who get them are low income people. No, I'm not just saying anything bad about low income people, but it is low income people. Or someone who's got, mom's 70. We don't have enough money to bury her, which is very common. Okay. Very common. 70. You could take a policy out onto someone up to age 85, even, believe it or not. It's going to cost more. So those are policies like that. So I'm going to move it along a little bit here. But the whole life policy is something a little bit more complicated. It's a policy that you're going to pay that will be in force. Okay. So we're asking about the term policy. It will be in force until you reach past age 100. So at least 95, typically 100 or age 105. And technically it goes out to age 122. All insurance policies expire at age 122. Okay. So there's precedent for that. If you're interested, see me Sunday. But a permanent policy is meant to be in place your entire life. Okay. As you would imagine, it will cost more. All righty. Now, how much more? I really can't answer that on this call. It really depends what the purpose is. Okay. So I'll give you an example. I'm self-employed, have been most of my life. Okay. I have 2 index universal life policies, which are variations of whole life policies. They're in place until I'm age 100, and I think mine goes to 105 or 108. Okay. But I've been putting in $400 a month for the last 18 years into these policies. Okay. They pay a dividend and they have cash value. Okay. So if I should die tomorrow, okay, my beneficiaries, my trust in this case, would get roughly about $400,000. Okay. But realize I've been paying into it for a while, and the cost of insurance goes up as you get older. Okay. So you take someone with Chad who's about 50 and a guy like me who's 66, my insurance costs a lot more than Chad's. Okay. And Stephanie's would be less than Chad's, and Adam's would be even less, you know. So I use mine for retirement purposes. Couple of reasons. One, I want it in place. When I die, I want my trust to get X amount of dollars, and I want to make sure that my kids all get something. I want to make sure I leave money for the church. Okay. But in the meantime, that's also my retirement plan. I will have X amount of dollars built up from all the dividends that it's paid over 30 years, or depending when I start utilizing it. What I do is I borrow against my cash value. Okay. So I pay 0 insurance on it. So it's a great option to 401k plans. I'm not fond of 401k plans. We could have that discussion another time. People are great. They match my money. Yeah. But when you take your 401k out when you're 75 years old, you might be paying 50% taxes on that money. Okay. And the way our government's going, it's not that far-fetched. So quick question for you about taxes. Chad and Diane probably know this. What was the highest federal tax rate ever in the United States for the last 100 years? Federal tax rate, the highest ever.
I want to say it was in the 40s.
It's at 37. It's at 37% now. Okay.
44, 45% or something like that.
45%.
Anybody else want to venture a guess? All right. 90%.
Yeah.
90% was the highest federal tax rate ever in the United States after World War II. They had to replenish everything. So in the years 1948 to I think 1954, it was 90%. Okay.
Holy
So
Lord.
do you think taxes are going to go up or down when, I'm looking at many younger faces here. Okay. I'm only 8 years away from having to take money out. I have a small 401k, from years ago, but nothing significant. But I'm going to have to start taking money out of that when I'm 74. So you should imagine if having to take out your money in your 401ks and pay 90% taxes on it, or even 50. Okay, we're at 37 now, so it's not that crazy of a number. So I like whole life policies for a number of reasons. One, for me, I could either build up cash value, I could turn it into an income stream, and I'm not going deep on these. These are really complicated, and I have to be compliant. I actually have to give you a full presentation on paper, but we could plan legacy planning for this, retirement planning, and long-term care planning. 2 out of 3 people in this country are going to need some form of assisted living or extra help. 2 out of 3. There's 6 of us here. So 4 of you, 4 of us are going to need some kind of assisted living, some kind of health care, cooking, cleaning, toileting, shopping, preparing food, getting us out of bed, transporting us out of bed, into our wheelchairs, whatever. 2 out of 3. So that's why you would have a permanent policy that has these extra benefits in it. Okay. I even write policies now. We take someone, who do we have? Adam on here. Adam's what, 30 or so? I even write policies on people as young as him. Just say, if something should happen to you, it'll pay out your policy. God forbid you get an illness, okay, cancer. I know young people with MS, Parkinson's. It'll pay out the life policy while you're alive, so you could actually use it for care. So I hope I'm opening some, expanding some minds here. It's like, it's not like insurance. I drop dead, they ain't get $1 million. It can be that simple, okay, but it actually could be very complicated. So you leave a legacy for kids, retirement planning, long-term care planning, income generation, leaving money to a church or another charity that you like, tax-free funds for long-term care. I mean, these are all the things you can do with life insurance. The other one is insurance for children. I really recommend that you should have a life insurance on your child. It's not that you're taking a bet that they die, at 10 years old and you're going to get a check for $25,000. Sadly, I actually had life insurance on my granddaughter, and she passed away 2 years ago. I was looking forward to giving her the policy when she turned 18, and it had built up some money already. And so it does happen, rarely, but it does. But it's a way to build wealth for your kids as well. Okay, so I have one for my grandson, Liam. I only put $100 a month away for him. But when he's going to be 40, he's going to have $200,000 put away.
Wow.
Okay, tax free, and $400,000 of insurance. So for any of you who have grandchildren or children, it's a way to really set your kids up. Pay off their college, pay their weddings, maybe help with a down payment on a house. So I really recommend putting money away for your kids. And I do $100. Actually I have several policies for him. So, but that's one way to help your kids. So you're not here anymore, but they're going to say, wow, mom and dad aren't here anymore, but I have a $500,000 cash value and I'm 45 years old. Okay. Another reason you have it on children, God forbid something happens to them and they become uninsurable. Okay. Our youngest son, Christian, had cancer. You couldn't write insurance. Now you can. It's been 8 years. But if they get something terrible, they wouldn't be able to get insurance. So I'm going to wrap it up a little bit. Like I said, it's a final expense, business loans, creating some kind of legacy. Okay, maybe you already have lots of money. Okay, like I said, I don't want to know anyone's financial situation. It's all private. But right now, if you're 30, 40 years old, you could buy insurance for about 10 cents on the dollar. It's like I said, $1 million policy. If you want to create some wealth, future wealth, some legacy planning, you say, hey, I got 3 kids, I die, there's $500,000 going into the account for our kids. It goes into a trust. On every birthday, each one of your kids could get $5,000 for life. I mean, I've seen things like that. If you're working with a lawyer,
Wow.
just things like that. So I'll put up for some questions.
Yes.
Yeah, if anybody's got questions, this is incredible. Like, I'm learning a lot. Listen to this, way more than what I even thought of. So I'm so happy that you are sharing all this tonight.
We started with the simple stuff, right? We started with the house, with the vehicle, with the health plan, and then you took us to another level, because it is the truth. For example, my dad is 82 years old. My mom is turning 79, and as we see them going, growing older, and we see our uncles, and we understand the value. For example, you were sharing, I didn't know that there was a life, what was it, Florian, when someone would take care of you when you're older?
Long-term care insurance. Yeah, that's my big focus now.
Most definitely. There is so many baby boomers, right? And many of them, they don't want to live with their children. My parents included, they want autonomy, but then that also comes with an expense, right?
Mhm. Yeah. I have an app on my phone. If you ever schedule time with me, I'll show you what it costs. But right now, even 100 hours a month, okay, so 25 hours a week of home health care. I'm not talking about a nurse. All right. So no wound cleaning, no memory care. This is for someone to come to your house to cook, clean, maybe give grandma a bath once or twice a week, do their shopping, comb their hair, change their pajamas, do the laundry. Okay. Right now, that's about $3,500 a month. Okay. That's about $40,000 a year. All righty. And that's for 25 hours a week. Okay. Who's taking care of grandma? I just went through this with my mother. So I'm trying not to get too emotionally involved in this conversation. And you hear things like, this is how I ask people. I said, are you willing to lift your mother off the toilet and wipe her and change her diaper? They'll never happen to me. I'm like, well, I said the same thing until 2 months ago. That's what I was doing 4 times a day. Okay. And I thought that would never happen to me. And the argument and the discussion was, well, who's paying the caregiver almost $40 an hour? Okay. And we did not have long-term care, but long-term care was a lot different back then. Now it's lots of different ways, but you can actually have a life insurance policy that says, hey, Diane can't do 2 activities of daily living. So there's a total of 6. So Diane can't get out of bed. They can't get out of bed. They can't do their laundry. They can't go shopping. If she can't do 2 of them, her life insurance policy will start paying some amount out of that. It depends on the carrier. There was a question about special needs.
Yeah, Sharita asked, what are the options for special needs children if they are denied by a previous insurer?
Okay, so I have an unpleasant answer. It's like underwriters are very tough on that. Okay, even if kids have ADHD, they're almost uninsurable. Okay. So the kids it's not the kids themselves that need that need life insurance. For you guys, if that's some, you're asking for yourselves, you guys really need big policies. Okay. I'm not trying to sell you anything, please, but I just, if any family that's concerned about their special needs child, okay, and there's a bunch of them at our church. I'm working with one right now. And she's, oh, I have a $60 policy when they die. That's when we're going to leave my daughter. Well, your daughter's only 41. Okay. There's nothing physically wrong with her. She has mental disabilities. She could live to be 80 and you have $60,000 for her. Okay. What happens after the 60,000 gone, which is about 1 year's worth of room and board somewhere? Okay. This is the kind of person that honestly should have $1 million on them if you have a special needs child, because what you're doing is you're funding that child's care to age 75 or 80. Some kids have physical disabilities. They might not live to be 80, but if they're healthy and they just have mental disabilities. So yeah. So the question is writing a bigger policy on the parents, or one of the parents at least, maybe the younger one or the healthier one. Okay. We write joint policies where the insurance gets paid out when after the second parent die, both of them need to die. So it's called survivor policies. But that's a discussion. That's really when you got to sit down and take a lot of notes and ask a lot of questions. But that's what we do. So you're not insuring the kid, you're not insuring the child. Child doesn't need life insurance, really, because when they pass away, who are they leaving it to? But I also do it. We did one for church. He didn't go to our church, but it was someone who was about 68 in good shape. Said, I got $100,000. I want to leave my church. And I said, great, would you like to leave them 150? He goes, well, how do I do that? I only have 100. I said, well, we could take a life insurance policy, pay it in full. And then when you pay it in full, you have to have that money. Okay. You get $150,000 benefit if your intention was to leave 150. What he did was he took a policy out for 100,000, okay, which cost him about $70,000, $30,000, and he used it for his own retirement. So he had a little bit more liquidity. So if you're older and in decent shape, you could do some pretty fancy, pretty cool things with insurance if you have a lot of money. Okay, I'm not even going into taxes and 1035 exchanges. There are tax advantages. I'm working with someone now who's moving about $200,000 into a long-term care policy. He is paying zero in taxes to move the money from a 401k into a long-term care, and he's going to get about $800,000 of coverage for long-term care.
Wow.
Okay, and never pay taxes on the 800,000. So there's some really interesting things we can do. You want to protect your family first. Okay, if you're young like the Lefferts, and Levert, your family, you want to protect them so something happens to you, your wife, your husband goes on with a normal lifestyle, that your kids don't have to be in the street and you don't have to put your kids everywhere. Okay, if you're older like me, the older you get, the fewer options you have. Okay, for me right now, life insurance is pretty expensive for me at 66. So I would not look for another life insurance policy. But in your 50s and you're in good health, you could do it. If you have a lot of money, you could really have some bang for your buck. So legacy planning, protecting, income planning, long-term care planning, giving, creating wealth for your kids. These are all the things you could do with insurance, but you got to do it one-on-one. So I know I went on for a bit.
No, this is really good. I mean, this is eye-opening for all of us to hear all the different options, just beyond getting a death policy, a death benefit, basically. I mean, there's so much we could do with insurance to even offset some taxes. I like the idea of that, because that's really what we want to do. A lot of times is to help grow our wealth. We want to offset our taxes because, like Florian said, we don't know what the tax rate's going to be. I mean, I do taxes for people already, and I see people paying 25, 35% tax rate, and these are people that work modest jobs. They don't make a lot of money, and they're paying 35% of their income back in taxes. And then there's other people that pay zero in taxes and make $300,000, $400,000, $500,000 a year. So, and this is all done through planning, like Florian's talking about. There are ways around to pay zero in taxes if you're wise and you get the counsel to do it. And this is one of the ways.
The indexed life insurance policy, I won't go into the details. If you're young, I did it a little later. I did it when I was like 53 or so. I wish I had done it when I was 30, but if you're relatively young, you could start funding that. And it's really significant. It's tax-free loans. I mean, literally tax-free money.
Wow.
You borrow we're doing it. I mean, they're taking out $40,000, $50,000 a year tax-free.
Wow.
So, you could do the math. What do you pay on $40,000 or $50,000? So there's smart ways of doing it.
Yeah, that's really powerful.
Yeah, I think that's the advantage of knowledge. And Florian, thank you so much, because the information that you share, it could feel that it's only for very wealthy people, but it's actually for all of us that are here. It's only about having the conversations and seeing where we could be at, right? Because you said you could start, but you can change it as well, right?
Yeah, you could change.
Yeah, go ahead.
No, I said you could change it. You could add to it. I mean, we could design it a lot of different ways. I have some people putting $25 a month away. I have some people putting $700 a month away.
Mm-hmm.
They're also some are younger, but Yeah. I mean, we have annuities where if you're under 25, you can put as low as $25 a month away. Just get used to save. Just get used to saving something
Yeah.
into
Forced
something.
savings. It's really forcing you to save and
Yeah.
create habits.
In a different way than just putting the money into a bank account,
Yeah.
right? Because this is a
Yes.
different complete tool. We don't learn about this at school. Before we
No.
graduated from high school, no one said, hey, by the way, you should start thinking you're 18, but by the time you're 22 or 25, you should start thinking about life insurance or all of these other options that you've mentioned, right? We
Yeah.
started with a very simple car, the mortgage, and now we're going to a complexity that none of us or some of us have not heard before. And that's why we wanted you to join the call, because you are exposing us to information that is not shared openly. It's basically for some level of people, right, of wealth. But we are believing that and this is why we do the Diversify. The idea is that your income and your wealth will increase so you can be more generous. And in order for us to get there, this is an opportunity. It's the different insurances. I was able to see generosity when you mentioned that the beneficiary could be a church or a nonprofit organization. You mentioned your children, your grandchildren. And sometimes we think, well, I need to work all my life. And then when I die, I'm going to leave them, for example, my house or my land or business, right? But then we have never thought that you can actually leave as a part of their inheritance a life insurance, right? The money that you've been putting there for some time. And it's not just putting savings into a bank account that makes maybe 1% for the year, but this will actually grow more.
Yeah. I mean, I had this conversation with Pastor Josh, and I said, this is how churches build a $10 million building. You know, you get a handful of people or maybe one family that takes out a large life insurance policy and they sell 500, even $1,000 a month. I have someone who's putting in $2,000 a month into a policy. Okay. It's the biggest policy I wrote. Okay. But the death benefit is over $10 million. And the beneficiary is a 501c3, is a charity. It's actually several charities. And they said, this is what we're selling. We don't have $10 million to give them now. Okay. And they might never do, but they said, no, we can afford $20,000 a year, for 25 years. That's half $500,000. But when they die,
Yeah.
the church is going to build a building. Get
Wow.
$10 million, they could take probably $1 million out a year and never touch $1 million.
Wow.
Imagine leaving that for your kids if you want to.
Yeah.
That you die and you leave them $1 million. If you have a special needs child, you die and you leave them $1 million. Effectively, that gives them about $100,000 a year properly managed for their care. Okay, or they get to stay in the home. I have someone right now that's the whole thing is they want to stay in their home. I'm like, okay, then we really got to up your, it's people with $60,000, which is ludicrous, and they're educated people. It's not like, it's not like they work carnivals or something. It's like these are fairly educated people, and they really thought $60,000 was enough to leave their adult daughter when they die. And I'm like, she's gonna be out of your house in a year or two. So it's like, okay, what do we do, Florian? Major shifts in budgets, moving some money around, cutting back on some things, selling a vacation home. That's what it takes. What are your priorities? Your vacation home or your kid?
Yeah.
I have some pretty tough conversations with people about this.
It's true. We have to do this. This is like, gets me thinking, how should we do things differently, and what are some of these tools that we could utilize ourselves that we haven't even thought about, even for our kids, insurance for our kids, because insurance does, for the average person, when it comes to life insurance, has a stigma like, they're just trying to sell you, but nobody ever gets to the point where they talk to a Florian like this to hear all the different benefits, because our minds are already closed off before we even get to that point right there. Because nobody wants to talk about death, for one thing. Nobody wants to think
No.
about themselves dying. They don't want to think about their child dying, their parent dying. So we just avoid it. Just like we avoid creating budgets for our family because we don't want to talk about not having enough money to do the things we want to do.
Yeah.
So these
Yeah.
are things that we typically avoid as humans, but they're probably the most important things that we should be addressing. You know,
Yeah, and stuff happens. I mean, we say, "Oh, I'm
Yeah.
not going to die at 50." Geez, I mean, we know people that
Yeah.
I know people in their 40s and 50s and 60s that they die there, and the wife's like, "Well, your wife still has 2 teenagers now; she has to go to work."
Yeah.
I mean,
That's tough.
that's just heartbreaking for me to
Most
do
definitely. Most
that.
definitely.
Yeah.
And life is so expensive right now. And
Mhm.
like I mentioned, there's so many baby boomers, the population. So I know that there's many of us that know people or our aunts, uncles, our own parents that are over 75. And we ourselves have gone through it, right? And it's like we want to give excellence to our elderly. We want to honor them. We don't want them to be forgotten. Myself included with my dad, you know, we had to do different things to be able to get him to where he's at because he had a lot of different issues with his body because of a car accident and now his age. So thank you, Florian, so much.
Yeah.
This have
De
been
nada.
so much wisdom and knowledge that will really make us think, like you
Yeah,
said.
it's got me thinking. I'm sure
Yeah.
it's got Deanna thinking too, and many of you guys.
Yeah, if you want, just you could email me or text me. But all of you have my text, my phone
Yeah.
number. It's Indiana Advisor at iCloud.
Thank
Indiana.
you. And we're also going to share your information, Florian. We're
Good,
going to be
thanks.
sending some communication between now and our next meeting.
Mhm.
So we will share your contact information with everyone. So if you know people want to reach out, they want to ask questions, they can do that.
Yeah. All right.
Florian, could you say that email address one more time, please?
Sure. It's Indiana Advisor, ADVISOR at iCloud.com.
Thank you.
Yeah, and we'll send it out. We'll send it in an email for you guys, so everybody will have his contact information. This is part of Diversify. Is we're just sharing information. We're not paid to do any of this stuff. This is literally like for you guys to learn what we've learned, and like tonight we learned what Florian knows that we could utilize, so we could all become, you know, better equipped for the things in the future.
And maybe this wasn't directly for you, but maybe again your parents, you know, someone that needs this kind of insurance. And I love the one that you were talking about, the long care.
Well, long-term care.
Most definitely reach out, you know, your parents,
Please.
your uncles, neighbors.
Yeah, there's please have it. It's affordable, and you have different options. There's annuities that we can do too, but I'm telling you, 2 out of 3 people are going to have a need for that.
We've seen my dad, her dad. We've all seen it. We
Most
have
definitely. I have 4 grandparents, as all of you, and then you know, when my grandmother passed away from my dad's side, my aunt was there. She was single. She was able to take care of them, and they had 11 kids. So there was many hands. On the other side, from my mom's side, they had 4 children, 2 male, 2 women. And the reality was that while my grandmother was able to take care of my grandfather when it was her turn, it wasn't the same experience. And we really had to think about what were her savings, how to make sure that they will last for any amount of years, right? That she will live. We have to think about what about if she lives until 90? How can we give her quality of life to a woman that has served us so well all of her life, right? So those are the conversations. We don't want to wait until they're 90.
I don't know, Chad. I mean, Diana, you ready to put your life on hold and take care of mom or grandma?
Well, you know, that was a real question with my dad because, like I mentioned, he's 82. He went through a car accident when he was back in 2005. So he, I went for a couple of days. I couldn't lift my dad up, I couldn't get him out of the bed. I can even shatter myself. And I don't know, I think there was a third person.
Yeah, your brother.
We were trying to help my dad, and we can't even almost lift his legs
Out of the car. It was like, because we're not trained. We don't know how to do that.
Yeah,
love him.
and that's the other
Yes.
thing. That's the other thing, training. And yeah, so I ask people, what kind of quality of life do you want in retirement? And so
Yeah.
they'll say, oh, we're going to get a trailer, or maybe we'll get a condo in Puerto Rico, whatever it is. I'm like, how are you going to pay for it?
Mhm.
And I said, and what if one of you gets sick and the other one has to take care? Are you going to take care of Frank or Mary? And what
Yeah.
will that do to your finances? Well, I want to live in Arizona and blah, blah, blah. And okay, well, that's $100,000 a year. Will you have it? And throw in long-term care. I want to stay in my home. Okay. That means we have to send someone in at $1,800 a week. Who's paying that? You?
Yeah.
Those
So,
are the
yeah,
real
yeah.
questions. That's why
Yes.
we're so thankful for your time. Thank you,
You're
everyone.
welcome.
Listen,
It's nice to see
throughout the
Sharita
month-
smile. Sharita had a very serious look on her face for the last 5 minutes.
but
I
throughout
was
the
taking notes.
Yeah,
Yes.
you both are a very thinking couple. But I saw Sharita, she's just like, man, these numbers.
Yeah. So we're gonna be sending information throughout the month. Feel
Mhm.
free to reach out. We are building a community so we all can ask questions and we can answer each other as well. Maybe not all of us have the answers, but we can find answers for you. So we're wanting to continue building our community. So go into the community, post your questions, and let's keep building each other up.
Yeah. So
Okay.
remember, we're here so everybody can become generous. That's why we're doing this. So
Yeah.
the more that we're able to save and grow our wealth, the more generous we can, and the better it is for everybody around us. So we're so grateful that you joined Diversify tonight. Stay connected to us. Tell friends, family, anybody that you know. This is open to